Hi folks, good day to you. It is another week of chaos for the stock markets under Donald Trump. Welcome to another episode of Investment Income for Life. Today, I will be touching base on the recent developments on the U.S. office commercial REITs listed on the SGX, as well as the curse of the 9.8% maximum unit holders that are crafted in the trust deed of these U.S. REITs. I used to hold all the U.S. office REITs of Manulife U.S. REIT, Must, Keppel Pacific Oak REIT, Core, and Prime US REIT, Prime, listed on SGX. Post-COVID, all three REITs imploded in varying degree due to the work-from-home trend. I have then sold off the weakest two commercial REIT of Must and Prime and allocated the funds to Core, which I thought held the strongest balance sheet relative to the other two to mitigate the risk of bankruptcy while waiting for the U.S. office market recovery. So, two main points to discuss today. 1. Must debt restructuring on track. Basically, Must selling off of properties are on track to meet the debt restructuring plan imposed by the bankers. The only tragic part is that Donald Trump's import tariff imposition led to sudden uncertainty in the business environment and led to a 19% discount to net book value of Peachtree office building, but nevertheless, this is still higher than the current market price of $0.066 United States dollars per unit of Must, as at the 6th of July 2025. Which is just a fraction of its net tangible asset value per unit of 24 United States cents. Nevertheless, the same storyline of huge potential upside of 100% to 200% for the three U.S. office REITs, which are trading at record low to their net asset value per unit, hit a major issue that has often been neglected and forgotten, which I will elaborate below. 2. My beef with U.S. commercial office REITs. The often forgotten issue is that during times of crisis, U.S. commercial office REITs are unable to tap onto its sponsors or existing unit holders to raise much-needed funds to survive the crisis. The major hurdle is the problem of the complex holding structure designed to minimize withholding tax in the rental return to unit holders. The sponsors are thus unable to underwrite the rights issue during crisis time, as their own unit holdings will exceed 9.8%. So far, one of the solutions we've seen during such crisis time is the selling off of office building at fire sales price for Must and Prime. Core also announced in 2025 the sales of non-core assets. This is not exactly an ideal solution and, as a matter of fact, a really bad move. The other solution is private placement to third parties at extremely dilutive pricing. Must tried that but failed in the face of institutional investors' protest at the grave dilution for existing unit holders. A third fundraising solution will be, as per what Core has done, it has suspended all distribution to unit holders from 2023 to 2025 and only resumed payout in 2026 subject to improvement in U.S. commercial office space conditions. The retained distributions is akin to a forced rights issue where everyone will need to contribute, thus circumventing the issue of non-subscription, which will cause breach of the more than 9.8% individual threshold allowance. Parting thoughts and personal views. While current U.S. office REITs seemed very much undervalued, my personal thoughts are that retail investors may seriously need to consider whether it is worth holding on to a ticking time bomb, due to market cycle, or to consider an exit strategy once the price recovery plays out. Okay folks, that's all for sharing today. Please help click like and subscribe to support this channel. Have a great week ahead and may you be well and happy always.